Amazon reported earnings yesterday, and so far the market doesn't seem too impressed with the company's results. This is a stock that I have been continuing to add in my portfolio, so I want to update you all with what I am thinking on this one now. There's a lot I want to cover in today's video, so let's get right into it. As always, I went through Amazon's earnings report and I took screenshots of all of the highlights that I think investors need to know. So right away, we can see that Amazon's net sales increased by 9% to $155.7 billion in the first quarter. The North American segment sales increased by 8% year over year, international segment sales increased by 5%, and AWS sales increased by 17% year over year to $29.3 billion. Down here, we can also see that operating cash flows increased by 15% to $114 billion for the trailing 12 months. However, free cash flow did decline to $26 billion for the trailing 12 months, compared with $50 billion last year. So Amazon's revenues and operating cash flows seem like they are growing quite well, but the free cash flows did decline by roughly 50% year over year. And this is because Amazon is spending a lot of money on capital expenditures, as we're going to see when we take a look at the cash flow statement. But for now, let's head over to the next screenshot, which gives us their guidance for the second quarter. And here Amazon says, net sales are expected to be between $159 billion and $164 billion, or to grow between 7 and 11% in the second quarter. Operating income is expected to be between $11 billion and $17.5 billion, compared with $14.7 billion in the second quarter of 2024. So Amazon is expecting its revenue to grow between 7 and 11% for the next quarter, so it seems like revenue growth is maintaining to be around that 9% range. However, operating income does look like it is going to be lower in the next quarter, and this is exactly what I was saying in my last video when I was talking about how Amazon may lower their guidance for operating income in the second quarter due to all of the tariffs that are going on. So let's go and take a look at Amazon's cash flow statement now, and we can get a deeper insight as to what is going on here. So first off, we can see that stock-based compensation declined to about $3.7 billion in the first quarter versus about $5 billion last year. In the trailing 12 months, Amazon has done about $20.7 billion in stock-based compensation versus about $24 billion in the previous year. And I do like to see that Amazon's stock-based compensation is coming down, and it's been consistently coming down for about 2 years now. And I want to see this trend continuing because I do think the company was doing a little bit too much stock-based compensation. But moving on, here we can see that the inventory expense on the cash flow statement this quarter was $1.2 billion versus about $1.8 billion last year. This is a net change to inventory costs of about $3 billion year over year. Now, when we take a look at operating cash flows, if we zero out the inventory expenses on a year over year basis, then Amazon's operating cash flows this quarter would have been about $18.2 billion, and last year they would have been about $17.2 billion. So operating cash flows would have actually grown year over year if they weren't spending so much more on inventory this quarter. If we also take a look at the trailing 12 months, we can see that Amazon's inventory expenses were about $5 billion versus positive $3 billion last year. So this is a change right here of roughly $7 billion on a year over year basis. But despite this, Amazon did still see its operating cash flows grow by 15% over the past year. But without that increased inventory expense, it would have been even more. So I do think that Amazon front-loading some inventory expenses to get ahead of tariffs is causing the company's profitability to take a short-term hit. And I think that this is why the company's margins did decline slightly on a whole basis this quarter. Additionally, if we take a look at Amazon's purchases of property, plant, and equipment, which is the capital expenditures, it was $25 billion on this quarter alone. If we annualize this, this is $100 billion in annual capital expenditures. And on this quarter, actually, Amazon was free cash flow negative. They lost about $8 billion in free cash flow in the first quarter. Last year, in the first quarter, they spent about $15 billion on CapEx. So CapEx is up $10 billion for the first quarter on a year over year basis. In the trailing 12 months, Amazon has spent $93 billion on CapEx. And I believe that this is the most CapEx out of all of the Magnificent Seven. And this is what Amazon does. They don't really like to return capital back to shareholders in the form of buybacks or dividends, which is pretty much what every other Magnificent Seven stock is doing, or all of the cloud hyperscalers. Amazon isn't doing that. Instead, they're plowing almost all of the operating cash flow into CapEx. And this is why Amazon is able to invest more than the other businesses into CapEx and actually growing the business even more. I think that this is actually the best strategy. Because if this AI revolution and if, data centers and cloud computing and everything is truly underserved and these companies cannot meet the capacity or the demand of their customers, then if I was a business like Amazon, why would I want to spend a single dollar on buying back my stock or paying a dividend? I would want all of that money going into CapEx to meet the demand that the business is currently seeing. Because in my opinion, this is what would create the most shareholder value. And I believe that Amazon is actually doing the correct thing here by not returning capital to shareholders. And funny enough, I think that this will actually produce the most shareholder value over the long term. So it's very interesting to see the different strategies from all of the hyperscalers right now. And Amazon's is the most aggressive, but I think that when you have a supply problem, you kind of want to be the most aggressive, in my opinion. And this is one of the reasons why I am more attracted to Amazon stock than Google, Microsoft, Meta, and the other Magnificent Seven companies. This company, I think Amazon is just doing everything right in terms of creating shareholder value. Now, moving on, what I do want to show though is the trend of operating cash flows, and this is the metric that I focus on for Amazon. So last year, on a trailing 12 months basis in the first quarter, they produced that $99 billion in trailing 12 months operating cash flows. We can see that in the fourth quarter of 2024, they peaked at about 116 billion. So on a quarter over quarter basis, the trailing 12 months operating cash flows actually declined by about 2 billion. So Amazon's operating cash flows did come down slightly on a quarter over quarter basis. And I think that this is fine due to everything going on with tariffs. And as we saw, inventory expenses were significantly higher this year. And I just think that the company is facing more expenses right now in the current environment. But I did want to point this out because as someone who values Amazon's business off of operating cash flows, seeing the operating cash flows decline does mean that the price multiple is going to go up a little bit. Now, moving on to the next screenshot here, this is Amazon's different business segment results, and I'll just voice them out really quickly. Net sales from online stores grew 5%, physical stores 6%, third-party seller services 6%, advertising services 18%, subscription services 9%, and AWS was 17%. Now, if you want to pause the video and take a look at this table, the main trend that I am noticing is that every business segment at Amazon is seeing decelerations of growth. So for example, right here, third-party seller services, back in the first quarter of 2024, this business unit was growing by 16% annually. And this year, it's only growing by 7%. Amazon's advertising services last year in the first quarter was growing by 24%, and it's at 19% this year. AWS is the only business that is seeing the same growth rates on a year-over-year basis. So Amazon's overall business does seem like it is seeing a deceleration of growth. And this is probably due to the weakening macro environment that we're currently in, more consumer uncertainty, less consumer spending, and even businesses are pulling back on their overall spending as well. And this is kind of the trend that I also saw with Google and Meta. Meta's business, its growth is also decelerating, and so is Google's. So it seems like it just seems like we're seeing a deceleration to growth across the board for all of these large tech companies, and Amazon does not seem immune. So let's move on to the next screenshot now, and this is the total breakup of Amazon's net sales here. And the main thing is that AWS now makes up 19% of Amazon's total revenue, which is pretty dang incredible. And as AWS continues to grow at a faster rate than the overall business, this will continue to become a larger and larger portion of Amazon's overall business. This next screenshot shows us AWS's net sales, and we can see that they are up 17% year over year. However, operating income for AWS is up 23%, and AWS's operating margins are actually continuing to expand. And I do have a screenshot right here that I found on X, and this is AWS's operating margin. And we can see that over time, this business is actually becoming more and more profitable. And its operating margin is now sitting at 40%, basically, if we want to round up. And the operating margin at AWS did hit an all-time high this quarter. Now, what's also interesting about this is I think that AWS is the most mature cloud computing business. So when we're taking a look at Google, for example, I believe that their operating margin of the Google Cloud was about 17% in the last quarter. And I think that AWS gives us a good example of what the profitability potential is of different cloud businesses when they're more matured. So I think that Google Cloud could get to a 40% operating margin long-term as well. But right now, AWS is killing it in terms of profitability. and the margins are just continuing to expand. This next image came from Jamin Ball on X, and this shows us the different growth rates of AWS, Microsoft Azure, and Google Cloud. So we can actually see that AWS is seeing its revenue decelerate, as I said. Google Cloud also is seeing its revenue growth rates decelerate. However, Microsoft Azure is seeing its revenue growth accelerate. So Azure seems like it is the winner, at least in the first quarter of 2025, because this is the cloud computing business that is seeing the most growth, and its growth is actually continuing to uptrend, whereas the other two companies are seeing growth decelerate. So Microsoft is absolutely killing it. But don't get me wrong, AWS growing at 17% is still incredibly impressive. All right, now let's head over to Amazon's Q1 2025 transcript, and I want to read some of the highlights that I found. So the screenshot says, and even though we have a lot of combined inference in those areas, I would say we're not even at the second strike of the first batter in the first inning. It is so early right now. And then I would just say on how to think about relative growth rates, you always have to, the year-over-year growth rate is really only a function of the percentage growth on the base with which you are operating from. And we just have a very meaningfully larger base on the technology infrastructure side than others. And so when it's still think about 17% year-over-year growth on a $117 billion revenue run rate, it's still pretty significant growth. And as I said, I think we could be doing more if we had more capacity, and I expect that the capacity to ease in the coming months. So this was Andy Jassy, the CEO of Amazon, talking about the AI business. And he's saying that they're not even on the second strike of the first batter in the first inning. Basically, he's saying that this whole AI revolution and this AI business that Amazon is building is still pretty much day one. It's not even really started yet. And he thinks that over the next 15, 20 years, this is going to become an absolutely massive business over at Amazon. He's also continually said that Amazon's AI business is a multi-billion-dollar business growing by over 100% annually. So it's more than doubling per year, which is faster than the cloud grew when it was producing around the same revenue rates. So he is remaining extremely bullish on Amazon's overall AI business. It's growing incredibly quickly. And he's also saying that Amazon still does not have the capacity to meet the demand of all of their customers. So I do think that Amazon should continue to expend as much as they possibly can in CapEx, and I'm happy they're doing so. So now let's go and take a look at how Amazon is being valued today. And currently it is trading for a price to operating cash flow of about 17.7. Its long-term average is about 24.4. So it is still trading well below its historical average price multiples. And the operating profits of this business are still growing by roughly 12% annually. And I think that this can continue to happen in the future, as Amazon's higher profit business segments are continuing to grow faster than the overall top line of the business. So personally, I do still think that Amazon is looking cheap in the market. I don't think that this was like a blowout quarter or anything like that. I think that it was a good quarter and a decent quarter, but I don't think that this was like a slam dunk. I think that Amazon's business is just continuing to grow. It's continuing to grow fundamentals and plug away. And it is worth noting that the business is decelerating along with the overall tech sector and the other Magnificent Seven stocks that we have talked about on the channel. Yeah, it's just worth noting that I think the macro does appear to be weakening a little bit because every single one of these businesses' growth rates is slowing down, except for Microsoft Azure. But overall, pretty strong quarter. I definitely think that Amazon is still looking cheap. And if the stock remains down or it continues to go down, then I will continue to add to it in my portfolio. Currently, at this very moment, I am happy with my Amazon allocation. It's around 6% of my total portfolio weighting. And again, that's where I'm happy with Amazon being for me personally. But if the stock comes down, then it will naturally become a smaller weighting in my portfolio, and then I may top it up a little bit. But right now, I do think Amazon is cheap, but I'm not actively buying today because I like my allocation, and I hope that makes sense. But with that being said, that is going to wrap up the video for today. And I do have a lot more earnings that I want to cover in future videos, but I wanted to spend a little bit more time and kind of deep dive Amazon's earnings and show you a lot more in-depth charts and give you my full opinion. So we'll be talking about PayPal, SoFi, Apple, etc., over the weekend, hopefully, and definitely into next week. If you did enjoy this video, then please remember to leave a like on it. And if you're new here and you want to see more content like this, then please consider subscribing to my channel as well. But with all that being said, thank you all so much again for tuning in. I truly do appreciate it, and I hope to see you all again in my next video.